Hi, everybody.
Good afternoon
Welcome.
and welcome. Oh, sorry, apologies there. Good afternoon and welcome to the DP Poland PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Niels Gornal. Good afternoon to you.
Thank you very much. Thanks, everybody. Thanks for your time. So today I'll be presenting with my CFO, Edward, over here. So my name is Niels Gornal. I've been in the Domino's game for 30 years. I'm an Australian living in Poland. I've been the CEO for DPP since June or August 2022. I've been with Domino's my whole life. I started as a 15-year-old, and this is all I've ever done. So I come from Australia. I was a franchisee in Australia. I moved to Croatia and bought the master franchise agreement for Domino's Pizza in Croatia. And my last adventure has been the Polish Domino's for the last 2 years. We also have Edward, our CFO.
Hello, everyone. Happy to be here with you. I joined Domino's Pizza Poland about 2 years ago in December 2022. I hold a different position for the 20 years. There were financial, strategic, and management positions in Mars, Kimberly-Clark, Smego, Levi's in Poland and also in the region. Right now, I'm happy to be with Domino's and ready to present some numbers.
Thank you. Okay, so look, it's been another big half for us. But sales are still going crazy, and we're really excited and proud to deliver our results today. And I think we've really set up the stage for the future with more profits, more stores, and more franchisees. It's taken us a couple of years to get the business to exactly where we like it to be. And now we're ready for growth in building stores and attracting franchise partners to our business. So today we'll be going through and sharing a whole lot of things. The big one is our sales momentum. So we've seen strong double-digit like-for-like sales again this half. Our average weekly order count is exceeding expectations. We're in our third year of double-digit growth, which we're extremely proud of. The momentum continues. So June was a record month for us, and we also announced in July and August, we were again 20% like-for-like sales. EBITDA, it's definitely flowing through to the bottom line. We added another £1 million to our bottom line. And what's really exciting to me is our franchisees' profitability is 30% up this year on the first half of last year, and they're sitting on about 13% EBITDA for the H1 2024. Now, when the franchisees are making money, this makes my job much easier. Focus for the rest of the year. Look, we've been very, very good in the last 2 years. I think since I've joined DPP, we've been very, very good at growing sales and growing customer counts. And what we've been slow on is building the stores and selling the franchises. That was just evolution. We needed to get to where we are today to start going down that path. So in the second half of this year, we are opening stores. We'll be sharing that with you. We've opened 6 stores already in Q3, and we have 9 stores under construction that will be opened by the end of this year. So that'll be 15 new locations for the second half of this year. So I think we're starting to prove that we can build these stores. I see no issues with repeating this next year. And hopefully we can, build another 25, 30 organic stores. Transitioning to a franchise model, so that's also started as well. We have some news to share on that. The big one is that we've sold 4 corporate stores to a franchisee in Q3, and we have a few more to sell in Q4, and many more in the pipeline for the next few years. Okay, so next page there. Okay, so group revenue, look, up a massive 26% for the first half year on year. So we're really pushing the sales. 26% is a really big number, so we couldn't be prouder. Our AWOC Once again, we're growing at a big number. 825 for us is a big number. Our short-term goal has been to hit 900 in the year 2026. At this pace, we'll hit 950 this time next year. So, it's going really well. I see 1,000 on the horizon, and I really want to catch our Croatian market, which is well above 1,200. So, I think we've got lots more opportunity, and that's where we need to be. We need to be 1,000 and then 1,200. Our group EBITDA, Edward will share much more information about our EBITDA, but we're 95% up year on year. So the top end revenue is certainly flowing through to the bottom. Our balance sheet is looking much healthier. We've paid off more than half of our debt. So now we're below 4 million debt to the company. That was thanks to the fundraise we did earlier this year. It was oversubscribed by double. So we decided to increase the raise by 4 million, and we paid that straight off our debt.
Referring to the revenue growth, 26% is a very good number, but the most important thing is what are the growth drivers. So when we look into like-for-likes, it's following the main pattern. We grew 22% up over the H1 versus the last year, and 19% growth. We grew 90% up in the volumes. That gives about 80% plus factor for the volume being responsible for the growth of the top line. And this is exactly what we wanted to achieve, just to grow the base of our consumers and prepare for the further expansion. What is also very important is the structure of the growth. We see that both channels, delivery and non-delivery channels, are growing more or less at the same pace. And majority of the sales for the delivery channel, a vast majority is coming from the internet and digital orders. That is also recognizable in the Net Promoter Score that went up by 22% year on year, and altogether impacted such a good result for the top line. On the cost side basis, we have two factors that's worth mentioning. The first one concerns the food costs, which started dropping about a year ago and have a massive positive impact on the structure of the P&L. The second factor concerns the labor costs. Poland and Croatia is still under the inflationary pressure in this area because of the minimum wage increase. Just to mention, over the last 4 years, the minimum wage grew almost 100%. But even with those growths, we are able to keep the labor costs under control with different optimization activities run on the store level and also in the headquarters. All in all, it translates to the EBITDA growing 1 million up year on year. This is almost 100% improvement versus 2023. And what is even more important, the pre-IFRS EBITDA is for the first time in the history positive for this company. We reach 0.2 million plus. Below EBITDA, there are no big changes, which we are also very happy of. And the impact on the loss before EBITDA is more or less the same as for the loss before taxation is more or less the same as for the EBITDA. We improved this line by more than 1 million, and we are negative only 0.5. Referring to the balance sheet, it's looking much better than a year ago, mainly because of the fundraise, but there are also a couple of factors that are worth mentioning. The first one is the refund of the VAT. After the dispute with the tax authorities, we were able to regain the 1.5 million pounds of the VAT back to our company, and this money will be reused for the investments and further expansion. In the balance sheet, it is presented under the receivables because at that time it wasn't paid out. The payment took place in July. On the passive side, the borrowings dropped from 7.1 to 3.1, and this is connected with the Malacan debt that was paid off more than a half. The maturity of the debt is June 25, and by that time, definitely there won't be a problem to get rid of this debt. Company for now is not leveraged in any way. However, with this development of the company and improving health of the P&L, we soon return to the banks for the discussion about the commercial leveraging of our business.
Thank you. Okay, so high volume mentality is definitely delivering our results. So we've moved the ball dramatically on our AWOC. That's our average weekly order counts in our stores. Like I mentioned before, we've been growing at 19%, adding 120, 130 orders per week for every store in the country. So, but we really feel that the runway is there for more. We want 1,200. And you can see by this graph, we are going to get there. The good news is at these levels, we're starting to be really profitable. So our franchisees are making 13% EBITDA at these levels. And in the corporate structure, we have stores matching our franchisees. We have stores doing better than our franchisees as well. But we have a bottom end of our corporate stores that we've identified that we need to improve the EBITDA to match our franchisees. So we feel that we can certainly bridge the gap with profitability between our own stores and franchisee stores. So that's an exciting opportunity for us in the future. I suppose I really wanted to point out this, we're growing the sales with volume. So it's healthy growth. Half one, like for like, 22.2% on our existing stores. There's some really big numbers. We're pushing through a lot of orders through our existing stores, and there's a lot more to come. And we're doing it with volume. So very, very healthy growth. Okay, so where are the sales coming from? Look, it's pretty obvious, but there's three ways to increase your sales. More customers, customers order more frequently, or the customer paying more for their pizzas. So new customers. So you can see here this half, we are dragging in a lot of new customers. So on the left-hand side, that's in thousands. So half one, 2024, we added over 100,000 new customers coming into the Domino's system in Poland. Now, in the first half, we only opened up one store. So this is all in our existing stores. So new customers coming into our existing stores, we're growing at 22%. Tick, we're doing such a great job there. Now that we're building the new stores, we're going to be bringing new customers into the Domino's system because we're opening up stores where we don't have an existing presence. So that's where a lot of our growth is coming from. Our brand's becoming stronger, and the customers are flowing in. Order frequency. So that started to pick up about 6 months after I joined the company. So, and I see that with, we just got our operations right. We got our menu right, where we changed our menu offerings. We changed the specs on some of our pizzas, and we started delivering our pizzas much faster. So, we got our operations right. At the same time, our CFO joined us. So she was with our company for 6 months as well. And, it just took her that 6 months as well to learn how to speak to the customers in the pizza game. And I think between Patricia and the great marketing team and our great operations team, that's when we saw the frequency starting to kick 6 months after we joined the company. Ticket value, we haven't increased the ticket value with inflation. That's a fool's game. If we passed on all of the inflation that we saw in Poland, we'll be doing 400 orders a week and we'll be in the red. So, we decided as a company, we're going to bank customers and we're going to grab market share. So that's what we did. And we increased EBITDA with volume. So we're in a very, very good position now. We couldn't be prouder. And I think our company strategy really, really worked. Net Promoter Score. Look, I suppose this graph really shows it all. The Polish team are doing a great job. The brand has never been stronger in Poland. I know the marketing team do a lot of research, for our brand within the system and what we need to do better. And, we've gone from a clear third and fourth to a clear second in all the research that we're doing. So our net promoter score is heading north just like this. So we're doing the basics right. We're making a great pizza, we're delivering it fast, we're doing it with a smile, and we're backed up with great marketing. So not much more to talk about there, but you can see why our sales are increasing, because we're just doing a better job and the customers are really noticing it.
Back on me, right? So when we talk about the growth of the volumes and the profitability, it is strongly visible on the slide that volume drives the EBITDA. I think you see this slide, some of you, for the third time, but this is the first time in the history when we can show 3 periods next to each other. On the left-hand side, you can see how was the structure of our stores with regard to the volumes, number of orders they generated. And 2 years ago, just 1/4 of the stores were generating more than 750 orders. Right now, this is close to 2/3 of the stores doing that number. And it translates directly to the profitability of the stores. 1/4 of our store network was profitable in 2022 for H1. And this year, we can say that this is more than half, and 85% almost being break-even plus. So adding year on year about 120, 130 orders on average to every week and every store gives us a move up on the EBITDA by about 3 percentage points. If we keep this trend, the forecast for the next year is very positive. Going further, this is the EBITDA by store, the corporate stores in Poland. And here you have a different perspective of what's happening in Poland in a 30-month period. When we compare H1s for the different years, you can see that 2022 was a massively loss-making period for our company. Last year, after the introduction of the high volume mentality and big work done on the consumer awareness and brand awareness and in incentivization of the consumers for the brand, we moved to the break-even around May, June. And from that moment onwards, we are positive on the EBITDA. The whole H1 for 2024 is positive EBITDA. The trajectory, the trend is still positive, and we expect it to continue.
Thank you. Okay, so this is the Polish estate over time. Look, frustrating that we've been going backwards. It's really frustrating to sit here and see less stores in the Polish market than when I started 2 years ago. But the facts are, we had a dozen or so stores, dozen or more stores that, we didn't feel had the opportunity for a future. So, if it was inside of a shopping centre and we had a store on the outside, we simply cut our losses and shut the store and moved on. If we didn't have one on the outside, we took our time to find the right location, to keep the customers that we had and move the shop outside the shopping centre. So we just need to move on. It's frustrating that we had to close the stores, but we're really happy with the store locations that we have now. And we're doing 25% more volume out of less stores. So I think what we did was the right decision. Very frustrating, but it is what it is. And I think sometimes you need to take a few steps backwards to move forward. So now we can simply get on and get to 200 stores. So you can see here, this is the big blue graph bar, and this is what we need more of. And this is what you'll see over the next few years. So I've repeated it again, but I'll say it again. We have opened 6 stores in Q3. We have 9 being opened for the remainder of the year. It'll be 15 for the half. So I think the proof is in the pudding, and I believe we can open up lots of stores organically over the next few years. Franchisee partners. Okay, so look, we're just getting started with this. So until we had the store profitability, it was a pipe dream trying to sell franchises to people, and it wasn't a good investment. Now we're down to under a 3-year payback ROI on buying a Domino's store in Poland. So it makes my job easier when our franchisees want to expand. We have 2 franchisees that are nearing the end of their debt. They're seeing that the ROI is under 3. and they're building new stores. So it certainly makes my job much easier. We've put a new head of franchising. He started with us the 1st of July. He comes with a wealth of experience. He's also on the share option plan, just like Edward and I. So he's highly incentivized. He's got lots of goals, lots of big goals, and lots of good ideas. So I'm really looking forward to seeing the franchisees that he can bring to Domino's in Poland. So far, we've sold 4 corporate stores in Q3, and we have 3 more to sell before the end of the year. And then next year, we'll continue through selling our corporate stores down and attracting new franchise partners to Domino's in Poland. In Croatia, we're excited to announce that we have our first franchisee building the store. His goal is to get that open before Christmas. So really good to see the confidence in the Croatian market and the expansion in Croatia. And the last point on this slide is the strong profitability, 13% up there, 3 percentage points up on the first half of last year. This is really exciting to see, and I can't wait to see what sort of profits these guys can produce by the end of the year. Okay, store number potentials. So this is the current status of us in Poland. So this is how many Domino's stores per million population. So we like to put UK and Australia up there. This is who we all aspire to and who we want our markets to be like. So you can see there, Poland today, we're sitting at 3 stores for every million people. Poland's a market of 36,000 plus million people. The opportunity is massive. Our goal, our short-term goal is 200 stores. That only puts us just over 5 stores per million people. If we can hit the European average is 11.2 stores per million people. If we can just hit the European average, we'll be at 400 stores. I've been sitting here for the last 2 years saying that the Polish market should have 500 plus stores, and I think you can see it here. We put Warsaw in there. I know it's a bit tricky, sort of, putting a city versus a country, but we really just wanted to show that it is possible in Poland. They do eat pizza just like everybody else. In Warsaw, we are at saturation. We have a lot of stores in Warsaw. We beat all of our competition in Warsaw, and we're sort of matching up at the UK numbers. So, this shows what's possible. Okay, Croatia. Okay, so in Croatia, like-for-like system sales are positive at 6.1. So we had Pizza Hut enter the market in December last year, and they entered Zagreb. Zagreb is where all of our like-for-like stores are, and we're still tracking up 6%. So I think it's a really good result, and we're pushing for more. It wasn't slowing us down, but we had to be cautious. So I think we've come out of that looking like champions in the market, and we're more excited than ever to build more stores. Not too much to say on this. We have 5 stores currently. We're in the process of building 2 stores. We hope to get them both open by the end of the year. That'll get us to 7, and the target for next year is to get to 10. Okay, our targets. So this is our targets for 2026 and 27. So our AWOC, this is, growing far faster than we expected. We changed our short-term goal to 940 by 2026. I think we'll hit that, hopefully sometime next year. Let's see. But like I said, I really see us hitting 1,000, and then I really want us to be matching the Croatian market at 1,200 plus. Number of stores. So I see a clear path to 200. Yes, without the M&A, it's going to be hard to grow at 25% a year and get to 200 stores by the end of 2026. But we are in the market. We are looking, but we are building organic, and we will get to organic. Sometime, if we find no M&A, we'll be there in 2027 at some stage, just building organic. So there's no issues there. I think we've proved that we can build the stores. We've got plenty of opportunity all over the country. We're finding it very easy to get into leases and build the stores. So yeah, watch this space, and we'll be excited to present our store openings. Franchise share, I suppose what's really encouraging there is, we've got a really good team in place. We've got two fantastic guys that are driving this. We've got lots of great ideas and lots of things to push. So I think that's the most encouraging side on the franchisees. The franchisee evidence is also very encouraging, and the fact that we're starting to sell down our stores now, and that one particular franchisee is doing really well since he's bought our stores. So I think everything's going to plan. Our targets are going to plan, and we couldn't be happier. So in summary, strong financial outcome. Our top end sales are growing fast, and it is flowing down to the bottom line. We want more. Just give us time. Current growth in customer counts is positioning our stores for future growth. We're now at a level where we can make good money out of our stores. 2 years ago, it was tough, and now we're at a very, very nice level, and we're just getting started. We want to uphold the high volume mentality. We don't want our growth to slow down. I would love to sit here today and say we're going to grow at another 22%. Who knows? But we're pushing for it. We want to preserve our like-for-likes, and we remain with our high volume mentality. Corporate store profitability is rising, but we want more. We want to bridge the gap between our franchisees. So I think there's some big opportunities there. We are actively recruiting new franchisees from the Domino's network and from external sources, and we've got a dedicated team incentivized, put in place, driving this. We're committed to rapidly increasing our store counts. The goal is 200 stores in the next 2 or 3 years, and H2 store openings are just the beginning. We have a strong pipeline of planned openings set for 2025, and store openings to date have been going great, so we couldn't be happier. Thank you very much for your time today. Thanks for listening, and I'm sure we'll be speaking soon.
Perfect. Niels, Edward, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Niels, Edward, as you can see, we have received a number of questions throughout today's presentation. And Alex, if I may now hand back to you to chair the Q&A and kindly ask you to read out the questions where appropriate to do so, and I'll pick up from you at the end.
Thank you. The first question that we've got is on franchisees. What does it cost a first-time franchisee to buy a Domino's franchise in Poland? Is there an upfront fee plus cost of buying an existing store, or do they just have to buy the store from you? And will you sell franchise areas to new franchisees?
It's on me, I suppose.
Do you want to take this up?
Yeah, it's not a problem. Yeah, so indeed, we sell the stores to the new franchisees. We guarantee some areas where the future franchisee will operate. For a specific quotes, it's difficult to talk with this audience. If you're interested in some more detailed discussions, you feel invited to some direct one-to-one discussions or sessions on that. Definitely, we are committed to grow our network in franchise world, and we are ready to discuss case-by-case specific solutions.
Yes, and there was plenty of towns to choose from, so absolutely.
Right.
Thank you. The second question is also on franchisees. Can you share indicative terms of store sales to franchisees, and is this a source of capital inflow for DPP?
Sorry, can you ask that again? Do we?
I think they're asking how much are you selling the stores to franchisees for?
Look, it just depends. It needs to be a return on investment. So typically businesses are selling for 3 times ROI. The more demands in a network, the more we can sell. So it really depends. At the moment, it would be 3. In the future, would like to sell them for more.
3 EBITDA, 3 times the EBITDA.
Yeah, correct.
Okay, cool.
Again, on franchisees, can you give some detail on the makeup of the pipeline of franchisees? Have they run pizza outlets before or worked in franchise businesses?
Okay, yes. So the pipeline of franchisees is all from within the business. So from within our business or from within the business outside of Poland. So yeah, all with Domino's experience. We are yet to go. I know Edward's sitting on a franchise panel in 2 weeks' time. We've got plans for franchise expos for the remainder of the year, but no, we are still yet to be advertising externally.
Okay, thank you. Next question. How many stores are still not profitable?
I think Edward answered that one. He can probably repeat.
That was on one of the slides. About 17% of the store network is still unprofitable, but there is one important remark to be added to this statement. Namely, a year ago, we had in our portfolio stores that were unprofitable and had no chance to be profitable in the future, and those stores were dedicated for the closure. Now we have some stores that tactically for the midterm, we keep them in our portfolio even as unprofitable because they are located in the cities or in the regions that are not saturated with the number of the stores. A good example is a city in the western part of Poland, which is Poznan. It has about 600,000 citizens there, and we are present there only with 2 stores. So basing on the numbers that Niels showed, the average per 1 million citizens and so on, we could easily be there with 10, 12 stores. So such regions, even if the specific store is unprofitable, those stores are kept because in the near future, let's say 1 to 2 years, we want to saturate such a region with additional stores, and as a network, the profitability of every single store will grow. We have a proof of that in other cities in Poland.
Thank you. The 13% EBITDA July year to date, is that pre-IFRS store margins for franchisees?
Yes.
And does this also include royalty franchisees paid to DP Poland?
Yes.
Yeah.
Thank you.
Yeah, that's their cost after.
It's EBITDA,
After expenses.
EBITDA. Yes, after all expenses, royalties, food costs, ordering online, and all this stuff.
Okay. Next question. I think they mean to say, if this level of AWOC is maintained, what is the expected payback on the stores being opened?
Look, at the moment, going on the franchisee profitability, it is under 3 years. So going on the average corporate store profitability, it's past 3 years. So it's really hard to say. But the stores that we're opening up are opening up with pretty good sales. So
I would say it's like whenever we decide to open the store, it goes through a specific funnel to decide which one should be open. And one of the elements of the analysis is, of course, the financial forecasts. We do not take a decision on the stores with the payback longer than 4 to 5 years. And this is definitely no-go for us because we do not want to lose our money. Most of the analyses that we are running right now are between 3.5 to 4.5 years as a payback period. And we accept that because we believe that with the ramp-up period of specific store and growing volumes for the specific period and growing saturation of the Polish territory, those stores should pay back quicker than the analysis show.
Next question here. Has the product innovation played a role in your sales performance, or will that come at a later stage as you finish fixing the basics?
Look, we've used that tool the whole way along. So, just like McDonald's, you need to have new news. You need to have news for the marketing team to yell and scream. You need new products for existing customers to come back. So, we just copy McDonald's. They bring out new products. They have ins and outs, new products all the time. We do exactly the same. So, it's not exactly because it's not that it's growing all of our sales. It's one of many things that we do, and we've been doing it for the last 2 years, and we plan to do it for the future ahead. Absolutely, it's a big part of our business.
Can Polish customers track delivery drivers on their way to delivering the pizza? And in order to reach the 22-minute delivery target, do you need to split stores?
So look, no, we do not have GPS, so that's one area we're falling behind our aggregators. Let's call that an opportunity. So no, at the moment, we do not track from, we track the whole process so the customer can see the whole process in the store, because we're all automated in the store. So the customer knows when we're making the pizza, when it's going into the oven. The customer knows when it's leaving, when it's ready for carry out. They also know when it's leaving for delivery. We also send a little text saying the driver is leaving. If the order is ready to pick up, we send them an SMS saying that the order is ready to pick up. We are not tracking from the door to the customers, from the Domino's store to the customer's door, but it's a project we're working on, so it will be there in the future.
Thank you. Next question here. How are you finding the property market in Poland? Is it relatively easy to find the store sites? And how particular demanding are potential sub-franchisees about which stores they can or can't buy?
Yes, real estate is a pleasure to work with in Poland. There seems to be 4 or 5 players that are growing. We all seem to be going into the same retail parks. And it's just a symbiote. It's working really well for the retail parks because we can sign up early. The 5 big brands get the good positions, helps them sell the rest of the leases. So we're finding it's very easy. In Poland, they seem to build the perfect sizes that we need. So getting the leases at the right price at this stage is proving well.
There was a second part of the question concerning how close we are in the process of the decision, which location to open or not. Our goal in general is to make the franchisee to some extent happy so that we are happy. Yes, if the franchisee entering a new locations causes losses for himself, very quickly it will become losses for us. So the strategy is that whatever the location is chosen for the openings, we want also our field force, the operational managers, to look at this location, because most of the time they know the neighborhood very well. And we also go through the financial calculations just to benchmark to other stores that we already operating, just to find out what's the probability of the success. And we will not be stopping the franchisees to open the new stores, but probably we will invite all of them to go through this process just to secure their packets and our packets in the future.
Yes, any franchise store lease needs to be approved by the master franchisee.
Thank you. I think you answered this question in response to an earlier question, but I'm going to ask it again so that you can make this clear. Can you make all of your current stores profitable?
Yes.
I would put this point a bit differently. If some of the store will not be profitable in long term, we will close it. Yes.
Thank you. Next question. How long would you let a non-profitable store run before you decide to close it or relocate it? Would you help the franchisee to choose the relocation site?
Look, it depends on the reason. So the stores that we've shut will, because they are in shopping centres and malls, the rents are too high, and most of the business was a dine-in business. And we're Domino's, we're a delivery business. So when you're in a shopping centre and it takes the poor delivery driver 4 or 5 minutes to get to his scooter, that's 4 or 5 minutes that the pizza's going to be cold. I mean, we're on average 7 minutes to the consumer. If you add 5 minutes running around the shopping centre, going up and down lifts, trying to find a car park, it's now a 12-minute-old pizza. So it just doesn't suit our business. The stores that we've got left, it's a volume issue. And like Edward said, it's because we don't have the presence in that town. So how long we'll leave it, it depends on the scenario.
Thank you. The initial term of the master franchise agreement terminates next year, being 15 years since signing. Is DPP in discussions to extend for 10 years as per the initial agreement?
Yes, we are. Yeah, and there'll be no hiccups with that. We're one of the fastest growing countries in the world, and now with our store openings in this half, the master franchisee in America is very, very pleased with us, and they'll be delighted to re-sign.
Going back to franchisees, can you explain what ongoing fees a franchisee could pay the franchisor in addition to the royalty fee, e.g., advertising and training fees? And if the franchisee signed up to all the options, what proportion of a store's revenue would the franchisee pay?
Look, I don't, we're not going to give out exact percentages on this forum today, but we have several. There is several fees that the franchisee faces. They have royalties, and we have ad funds. So all of the stores, including our corporate stores, put in a percentage of our sales, and that goes to a pool for our marketing department to advertise all over Poland. We own and operate our own online ordering, so there's fees included in that, but it's mainly a royalty and ad funds fee system.
Yeah, there would be like call center fees, online ordering, is what you said. There might be some fixed fees concerning with the firewalls and with the system security, because that is more and more important from the global perspective, and we need to secure those systems. We have a couple of examples in the world where the systems collapse for a week or so because of some hacker attack. So these are the elements, but they are not massive comparing to the royalties and other stuff that we mentioned at the beginning.
And look, our royalties and ad funds is in line with your typical franchise numbers.
Yes.
Next question. Is there any update on the GPS delivery?
No, we're working on a big project at the moment, and that seems to be next on our list. So it will be coming. We've been dragging it on, yes, but we're still working on an exciting project. We need to deliver that first, and then GPS will be next.
Thank you. I think we've got time for one last question. So let me ask you this. Are there any more countries that DPP can claim in or move into in Europe?
Look, I still think we've got 400 stores in Poland to build.
There are countries, but I would say priorities first.
Yeah, priorities first, yeah.
We have plenty of things to do in Poland. We see that there is a big potential to grow. And if we stabilize one garden, then we will move to the another. But definitely there are opportunities.
Our balance sheet and P&L needs to support us buying other countries. So we're not afraid of it. It makes sense for us. Being in the Central Europe, we can run countries around us. It makes sense for Croatia to run Slovenia. But the balance sheet and our profitability needs to be right to support that. So we know what we need to achieve, and look, hopefully we can do that in the future.
That's great. Niels, Edward, Alex, thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of DP Poland PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Thank you.